There is a specific kind of heaviness that settles over the world on a Saturday night when the financial markets are closed, but the anxiety of the global population remains wide open. It is a strange, suspended animation. The tickers have stopped moving. The red and green flashing lights on the monitors have gone dark. But the forces that drive those lights, the debt, the desperation, the supply shortages, and the geopolitical fractures, do not take the weekend off. They fester. They build pressure. And as we sit here in the quiet hours before the Sunday open, before the Asian markets wake up and begin to price in the reality of the world we live in, there is a feeling in the pit of your stomach that tells you something has shifted. It is not just a feeling, it is a vibration in the ground beneath your feet. For the last week, we have watched silver do things that the experts said were impossible. We have watched it defy gravity. We have watched it shrug off the attacks of the paper traders. But now, in the silence of the weekend, a new sound is emerging. It is the sound of a rumor. A rumor so significant, so structural, and so terrifying for the establishment that they are doing everything in their power to keep it quiet until they have positioned themselves to survive it. We need to have a very serious conversation about what is happening behind the closed doors of the world's major government mints. We need to talk about the whispers that are circulating among the wholesale distributors, the people who actually move the heavy boxes of metal, not the people who trade paper contracts on a screen. The rumor is that a major sovereign government mint, one of the pillars of the physical silver market, an institution that has supplied coins to investors for decades, is on the verge of halting sales, not because they want to, not because they are trying to manipulate the price, but because they simply cannot get the metal. You have to understand the gravity of this. A government mint does not stop selling voluntarily. They are in the business of seigniorage. They make a profit on every coin they stamp. They want to sell. The government wants the revenue. For a mint to hang up the sold out sign in the middle of a historic bull market is an admission of failure. It is an admission that the supply chain has broken. It is the equivalent of a gas station running out of fuel while there is a line of cars stretching for miles down the highway. It creates panic. It validates the worst fears of the public. And it proves once and for all that the paper price of silver is a lie. If this rumor is confirmed, and the smoke is getting thicker by the hour, it means that the breakdown has moved upstream. It is no longer just your local coin shop running out of inventory. It is no longer just the online dealers putting up pre-order notices. The problem has reached the refinery level. The mints cannot get the planchets, the blank silver discs that are stamped into coins. And if they can't get the planchets, it means the refiners can't get the 1,000-ounce bars. And if the refiners can't get the bars, it means the miners are tapped out. The chain is snapping at the strongest link. This is the context in which we approach the Sunday market open. The traders in Tokyo, in Shanghai, in Sydney, they know this rumor. They are positioning for it. And this creates a dangerous, volatile, and explosive environment for the price action we are about to see. The establishment knows that if the public realizes the mints are dry, the game is over. The confidence in the paper derivative market will evaporate instantly. Why would you hold a paper contract that promises delivery if the government itself cannot deliver? You wouldn't. You would sell the paper and buy the physical at any price. And that rush, that stampede from paper to metal, is what triggers the force majeure events, the cash settlements, and the collapse of the exchanges. So, what will they do? What is the playbook of the establishment when faced with a physical crisis? They will try to smash the price. They will use the low liquidity of the Sunday night session to dump massive amounts of paper contracts onto the market. They want to paint the chart red. They want you to wake up on Monday morning, look at your phone, see silver down $5, and think, oh, the rally is over, I should sell. They are trying to use fear to induce you to release your physical metal back into the market. They need your silver. They need the scrap supply. They need the weak hands to fold so that the refiners can melt down your grandma's tea set and turn it into planchets for the mint. But here's the trap, and it is a trap that has caught so many investors in the past. The paper price is becoming irrelevant. We are entering a period of bifurcation, a period where we have two prices for silver. We have the screen price, which is determined by algorithms and leverage in Chicago and London. And we have the street price, which is determined by the actual availability of metal in the real world. If the mints stop selling, the street price will disconnect from the screen price. The screen might say $100, but try to buy an eagle for $100. You won't find it. The premiums will explode. The real price might be $150 or $200. This disconnection is the death knell of the fiat pricing mechanism. It is the market saying, we no longer accept your paper definition of value. And for those of you who hold physical silver, this is the moment you have been waiting for. It is the moment where your patience is rewarded. But it is also a moment of extreme danger for those who are trying to trade this market using leverage. We need to talk about the margin rules. This is a technical aspect of the market that is often overlooked, but it is critical right now. The exchanges are changing the rules of the game in real time. They are implementing dynamic margin requirements. In the past, the amount of cash you needed to hold a silver contract was relatively static. Now it scales with the price. As the price goes up, the margin requirement goes up. This is designed to reduce leverage in the system. It is designed to protect the clearinghouses from default. But it has a double-edged effect. On one hand, it forces the longs, the speculators betting on higher prices, to put up more cash or sell. This creates selling pressure. But on the other hand, and this is the part the bears are forgetting, it also traps the shorts. The entities that are betting against silver are also subject to margin calls, and as the price rises, their pain increases exponentially. If they are shorting a market that is physically scarce, they are walking into a meat grinder. Shorting a commodity during a shortage is the most dangerous trade in finance. There is no limit to how high the price can go. If you are short a stock, the stock can only go to zero. Your profit is limited. But if you are short silver and you have to deliver the metal and there is no metal to be found, what is the price? The price is whatever the holder demands. It is infinity. The losses on a short position are theoretically infinite. And right now, the commercial shorts, the banks, and the hedge funds are staring into the abyss of infinity. This is why they are fighting so hard. This is why we see the slams at 2 a.m. They are fighting for their lives. They are fighting to prevent a systemic collapse of the bullion banking system. Because if one major bullion bank fails to deliver, the dominoes start falling. The trust evaporates. Every industrial user, every sovereign wealth fund, every billionaire family office will demand immediate delivery of their metal, and the vault doors will slam shut. The narrative in the mainstream media is that retail is selling. They tell you that the public is lining up at coin shops to cash in their profits. They show you pictures of people selling silver spoons. And yes, there is some of that happening. The distressed middle class is selling to pay bills. But that is a drop in the ocean. That is noise. The real signal is what the whales are doing. The real signal is what the industrial complex is doing. Do you think Samsung sells its silver stockpile because the price went up $10? No. They buy more. Because without silver, they cannot make phones. Do you think Raytheon sells its silver? No. They need it for missiles. Do you think the People's Bank of China sells silver? No. They are de-dollarizing. They are accumulating hard assets to insulate themselves from Western sanctions. The big money is buying. The smart money is hoarding. The only people selling are the people who don't understand what is happening, the people who think this is just a trade, not a paradigm shift. You have to choose which side of the trade you want to be on. Do you want to be on the side of the desperate retail seller trading real money for depreciating currency? Or do you want to be on the side of the strategic accumulator, the industrial giant, the sovereign nation? The chart on the screen is a distraction. It is designed to make you act like the retail herd. It is designed to trigger your fear and your greed. But the fundamental reality, the geology, the chemistry, the math, aligns with the accumulators. Let's go deeper into the industrial panic. We talk about investment demand a lot, but the industrial demand is the floor under the market. Silver is not just money. It is the most conductive element in the universe. It is the most reflective. It is antibacterial. It is essential for the green energy transition. It is essential for the AI revolution. You cannot have a modern high-tech world without silver. And for the last 10 years, the mining industry has been starved of capital. They haven't been exploring. They haven't been building new mines. So we have a situation where demand is exponential and supply is falling. This is Economics 101. Price must rise to destroy demand. But here's the kicker. Industrial demand is inelastic. That means that even if the price of silver doubles or triples, the industrial users will still buy it. If you are making a $100,000 electric car and the silver in it costs $50 instead of $25, you don't stop making the car. You pay the $50. You pass the cost on to the consumer. You absorb it. You do not stop buying. This means that the price of silver has to go much, much higher before it actually balances the market. It has to go high enough to incentivize us to recycle billions of tiny electronic components. It has to go high enough to make it profitable to mine low-grade ore in dangerous jurisdictions. We are nowhere near that price yet. $100 is just the starting line. So, when we look at the Sunday open and we see the potential for volatility, we have to frame it correctly. If they smash the price down, it is not a crash. It is a gift. It is a sale. It is the market giving you one last chance to exchange your paper for atoms before the window closes. Because once the mints officially announce the shortages, once the headlines hit the Bloomberg terminal, the physical window will slam shut. You will be holding paper dollars, looking for silver, and finding none. The trap that the title of this analysis refers to is the trap set for the bears, the trap set for the shorts. They think they can control the price with paper leverage. They think they can scare the physical holders into selling. But they are wrong. The physical holders have woken up. They have realized that the dollar is the risk, not the silver. They have realized that the bank is the risk, not the vault. When a population loses faith in its currency, the game changes. The old rules of technical analysis no longer apply. Support and resistance levels are meaningless when the currency is hyperinflating or losing credibility. We are seeing a shift in psychology, a shift from return on capital to return of capital. People just want to preserve what they have. And silver is the most undervalued, accessible vessel for wealth preservation on the planet. I want to address the three markets concept again, because it is crucial for navigating the coming week. The paper market is the battlefield of the banks. It is where the manipulation happens. It is where the volatility is manufactured. Ignore it, except as a buying indicator. The physical market is the battlefield of the people. It is the coin shops, the online dealers, the private sales. This market is tightening. It is signaling stress. Watch the premiums. If premiums rise while spot falls, buy. The industrial market is the battlefield of the nations. It is the strategic reserve. It is the supply chain. This market is silent, but it is massive. It is the dark matter of the silver universe. It exerts a gravitational pull that cannot be seen but cannot be resisted. The Sunday Open is the skirmish line. The Asian traders are the first ones over the wall. They often have a better understanding of the physical reality than the Western paper traders. In Asia, gold and silver are respected as money. In the West, they are treated as pet rocks. As the economic power shifts from west to east, the pricing power shifts with it. The Shanghai fix is becoming more important than the London fix, and Shanghai is consistently pricing silver higher than London. This arbitrage is sucking metal out of the West. We are bleeding ounces to the east, and we are doing it at bargain basement prices because we are too focused on the paper chart. The establishment is trying to execute a controlled demolition of the currency system. They want to inflate away the debt without causing a revolution. They want to manage the transition to a digital currency. But silver is the wrench in the gears. Silver is the honest ledger that exposes the devaluation. They hate it. They want to suppress it, but they are running out of physical ammo. You can only sell paper silver for so long before someone asks for the bar, and that someone is now appearing. So as you prepare for the week ahead, you need to have a steel spine. You need to be mentally prepared for anything. We could see silver rip to $130. We could see it smash to $90. In the short term, the manipulators still have some power, but in the medium term, they are dead. They are mathematically insolvent. They are short a physical asset that they cannot print. The rumor of the mint stopping sales is the black swan we have been warned about. It is the event that comes out of nowhere and changes everything. If it happens, the panic buying will be biblical. The websites will crash. The phone lines will be jammed. You will not be able to get through. This is why you must be positioned before the news breaks. You cannot wait for confirmation. In a crisis, by the time it is confirmed, it is too late. You have to trust your intuition. You have to trust the research. You have to trust the history of money. Every fiat currency in history has returned to its intrinsic value, zero, every time. There are no exceptions. The US dollar is not special. It is just the latest in a long line of failed experiments. Silver is the constant. It was money in Rome. It was money in China. It was money in the Wild West. It will be money after the Federal Reserve is a footnote in a history book. The Sunday prediction is this: volatility, violence, manipulation, but ultimately resilience. The price will bounce because the buyers are there. The floor is solid. The dip buyers are no longer just retail speculators. They are sovereign entities. You are trading alongside giants now. Do not let the Sunday night games scare you. Do not let the opening bell induce panic. View it as theater. View it as a desperate performance by a dying system. They are trying to keep the curtain up, but the actors are forgetting their lines, and the scenery is falling down. The Sunday Open is the witching hour. It is when the liquidity is thinnest. It is when the predators hunt. But you are not prey. You are a stacker. You are a guardian of real wealth. You have opted out of the casino. You are holding the chips that cannot be canceled. As we move into Monday, keep your eyes on the newswire. Watch for the mint announcement. Watch for the refiner delays. Watch the inventory numbers at the COMEX. The data points are all pointing in one direction. The physical squeeze is here. It is real, and it is spectacular. We are witnessing the end of an era, the era of easy money, the era of paper promises, the era of debt without consequence. That era is dying. A new era is being born, an era of hard assets, an era of truth, an era of accountability. It will be a painful birth. There will be chaos. There will be volatility. But for those who hold silver, It will be an era of prosperity. You have the opportunity to be on the right side of the greatest wealth transfer in history. Do not throw it away because of a red candle on a Sunday night. Do not throw it away because of a rumor. Hold the line. The silence of this Saturday night is deceptive. It is the calm before the storm. The wind is picking up, the waves are building, and the ship of state is leaking. But you have a life raft. You have silver. And that life raft is unsinkable. So let the markets open. Let the games begin. We are ready. We are positioned. And we know the truth. The mints are running dry. The paper is burning. And the silver is shining brighter than ever. Stay vigilant. Stay disciplined. And most importantly, stay physical. The screen is the illusion. The weight in your hand is the reality. When you see the price dip, smile, because you know it is the desperate flailing of a drowning system. When you see the price rip, stay humble, because you know it is just the market catching up to reality. The week ahead will be one for the history books. We are living through history. Do not blink. Do not look away. And do not let go of your silver. The dawn is coming, and it is silver-lined.